Thank you for that introduction, and also I will let our evaluation committees at McKinsey know that I was just promoted to director today. In reality, thank you for that, although in reality they would say they would describe me rather as a partner at McKinsey, not yet a director. This being said, I'm happy to be here today and to talk to you about the overall outlook and how McKinsey sees the outlook on iron ore. But let me first start by shortly introducing McKinsey for those who don't know McKinsey that well. McKinsey is a global management consulting firm with about 13,000 consultants across the world, working in all major sectors, on all major functions. In mining specifically, as you can see from this chart, we're also serving all key regions, all key players in the world on most of the topics that you can imagine that are relevant for mining companies. We have at any point in time about 200 people working in the mining industry across the globe. We do a lot of research and knowledge development in order to be able to have impact with our clients and to engage in interesting discussions like the one of today. So there's a whole set of proprietary models and tools that we have around supply, around demand, around pricing. Let me just briefly introduce you the latest model that we are adding to our suite of tools and models, which is our mining benchmarking tool, which is a very detailed benchmarking tool allowing benchmarking of the performance of the mines, both looking at what best practice looks like, but also allowing for identification of improvement levers. So I think this is the end of this short commercial break. Let's now go back to the real content. So what I want to talk about now is first a bit of a perspective on the global minerals industries. What are the key factors that are driving the economics and the dynamics in that industry, both what happened historically, but more importantly, how do we see this going forward? And then I'd like to spend a few minutes just on how we see the iron ore market develop. Looking at the evolution of both the revenues as well as the EBITDA of the mining industry as a whole, you see from this slide that it's actually not that cyclical, at least not on an annual basis. We'll see in a few slides that on a monthly basis it can be extremely cyclical. But if you look at what happened in 2009, it was only a moderate drop in the end in revenues, and still 2009 was at that point in time, the second best year in history for the global mining industry, where that can hardly be said about all sectors in the world in that given year. And also look at 2012, it's still quite a lot of economic uncertainty, difficult sectors across the world. Still the mining industry is at its second best year ever, and the best year ever was 2011. So we have seen a very sound and solid financial performance of the mining industry, and I'll argue that, and I'll come back to that in a few slides, that we will expect this to continue for the next few years. This strong growth in revenues and EBITDA is actually much less driven by volume growth, although maybe not directly, indirectly it is of course, but it is the primary drivers here are price increases as well as margin increases. Margin increases across all commodities as we see cost curves getting more steep due to factor cost inflation, geological cost inflation, which are especially affecting the marginal producers on the cost curves of many commodities. So we've looked at it around 50 or 60 commodities, and we see the same patterns around cost curve development across all these commodities. Although the demand factors might be quite different, on the supply side we see the same issues, and it's our core belief that this is one of the key drivers of the dynamics of this industry, which will keep driving the industry going forward, even if demand might be a bit more volatile than in the past or might slow down for some of the commodities. And just to illustrate the fact that the price increase of a certain commodity is not linked to the volume increase, what you see on this page is on the left-hand side, it's all the commodities ranked by decreasing nominal price inflation, average annual price inflation over the past years. And on the right-hand side, you see for those same commodities the volume increase, also on the nominal volume growth. And you see that, whereas, of course, on the left-hand side, it's all ranked by decreasing order, on the right-hand side, there's no correlation at all. So you had some commodities with very high price inflation, where volume inflation or volume increase, demand increase was not that important, whereas on the other hand we have had some commodities with relatively low price increase yet with significant volume increases. So we don't believe that or at least that the boom that we've had and maybe the dynamics going forward were entirely driven by a demand boom. But we will argue that there's a lot of the supply coming and driving these dynamics going forward. And this slide, I think, is quite telling on this. So what we looked at is cost inflation, both from an operating cost as well as from a capital cost, over the past 10 years, over a number of commodities. And what you see is that for the marginal producers, this has been consistently double-digit figures. So for iron ore, your nominal cost inflation on the cost side was 18% per annum, meaning in real terms about 15% cost inflation of the marginal producers. And that, we believe, is one of the single largest factors driving the price inflation and the margin inflation that we've seen in the mining industry over the past 10 years, and that to some extent will continue to drive it. Of course, we are not saying that these numbers are also the numbers that we expect for the next 10 years. A number of these inflationary drivers will be far less so, like energy prices. Of course, we've seen the increase over the past 10 years. We don't expect this to be as strong as it used to be, but still there are a number of fundamental factors like geological inflation, which is driving about 40% of this cost inflation. So take the example of iron ore, where you see an increase of concentrate coming on the market. So all the nice deposits which can be shipped, so direct shipping ores, no beneficiation required, we're running out of those. So more and more we see lower quality deposits being developed, requiring higher cost, requiring more beneficiation, and delivering a product which sometimes is of a lower quality and therefore has a value in use penalty, which you could also consider as a cost increase. So that is driving the cost curves and therefore also prices. If you look at it going forward, because of these dynamics, and as said, we're not as bullish about the cost inflation, of the double-digit cost inflation that we've seen in the past, but still we do expect some real cost inflation across the mining industry, around 5 to 6% going forward, and that will drive to a large extent prices and therefore revenues. At the same time, it puts a squeeze on margins. So where we are quite bullish still on a solid and robust growth on the revenues, the EBITDA margins themselves might see a slower growth for the industry as a whole. A couple of elements still before I dive into the iron ore part. on some of the uncertainties that are surrounding most of the minerals. And there's a number around supply, of course. I mentioned the cost and geological inflation leading to quite substantial changes in the shape of cost curves. Sustainable operations is high on the agenda of many minerals producers. From the macroeconomical side, there's of course a number of risks which cause quite some uncertainty in the market and volatility. On the resource side, we see also a number of challenges, and then from a political or country perspective, you have royalties and a number of other factors which lead to some uncertainty still on the minerals. So, in short, global minerals, we expect that profit pools as a whole will remain quite solid and still have quite some room for improvement. But this will not be the case for every single player in the market, and whoever is active in this market will need to have a certain stamina to deal with the volatility and uncertainty which will only increase. Talking about this volatility, this is my first slide on the iron ore market section. We've all, those following the iron ore market have all witnessed the steep drop of iron ore prices that we've witnessed early September last year, falling off from the 150s spot price to as low as 85, so nearly half the price. And we were not used anymore to these big drops in iron ore prices. So over the past years, we've only seen it go up, or in 2009, contract prices went modestly down, but not by these numbers. So, and this is to illustrate the increasing volatility that we see in the market. So what's driving this is that, first of all, Chinese demand or Chinese production of steel has been slow over the summer last year, and we see that actually in August, pig iron production was at an all-time low, or at least for that yearly low, so resulting in lower iron ore demand. At the same time, we have evidence that domestic Chinese iron ore production has increased. Chinese steel players were using unbeneficiated ores directly in their blast furnace in order to keep the blast furnace going at a lower productivity, at a lower rate, given the drop in demand, which has led to a substantial decrease already starting June, July, and then especially in September, October, of imports of seaborne iron ore into China. So if you combine that volatility in demand on a monthly basis, and by the way, we are currently, December 2012 was again the world record of seaborne imports, all-time record of seaborne imports in China. So this huge volatility, coupled with the fact that we're more and more now into spot-based pricing, and finally on the right-hand side of the page, a very steep cost curve, leads to this price volatility. And just as an illustration, a 15% drop in global utilization, which you can have on a month-by-month basis, leads to a marginal cost decrease on the cost curve of around $50 per ton, which is about the drop that we've witnessed in 2012. So, on the seaborne market, before I start forecasting the future, on the seaborne market, there's two main factors currently influencing the dynamics of the seaborne market. One is, of course, Chinese demand, and especially Chinese volatility in monthly demand. And as an example, we've looked at it, and on a monthly basis, the changes in Chinese monthly demand for iron ore, actually on seaborne demand, can have an impact of 10 to 15% on capacity utilization for that given month in the seaborne market. So given their importance of the in this market, their impact is huge. And then on the supply side, of course, the Indian exports, mainly towards China, which upon an export ban would also have a significant impact on capacity utilizations. And again, with a very steep tail of the cost curve, this causes quite a lot of volatility in iron ore prices. Looking forward, this is the demand side for iron ore. So we're looking at, and of course there's as many forecasts out there as there are analysts out there, but we are looking at a still solid growth of iron ore demand up to 2020. After that we would see it slow down, especially in China, when the scrap pool starts hitting the market. So the old steel, the obsolete scrap that has been that was sold as finished steel in the boom time when steel demand was booming over the past years, will hit the market again as secondary metal around 2020-25, and we do expect a significant change towards more scrap use in China's steel production, leading to flat or slow-growing iron ore demand. But all in all, we're still looking at 2.5 to 2.6 billion ton of global iron ore demand. Now, if you look at what capacities do I need to satisfy this demand, so what this page is trying to show is that we had a 2.2 billion tons estimated capacity, global capacity of iron ore in 2011 for a total demand of a bit more than 2 billion. So we are a bit above 90% capacity utilization on a global level. Now, looking at this 2.2 billion tons capacity, how it might evolve towards 2020, of course, this is a depleting commodity, and we estimate and we model that depletion together with closure of marginal mines, especially in China, might drop the decrease total supply capacity by about 600 million. But then, of course, there's a number of projects which are already in the pipeline, which are expected to fully ramp up. So these are not new greenfield projects, but projects that were already initiated in 2011. Still, if you want to satisfy the 2.5 billion tons of demand and have a more or less balanced market in 2020, you would require about 2.8 billion tons of capacity. So by difference, you would need 800 million tons of new greenfield projects to be online by 2020, or about 1/3 of the current capacity. Now, you could argue 800 million ton, that's a lot. So it's with so many new capacities required, this must be a market which is extremely tight and which will be booming. Now, of course, the bad news from the recent 2007, 8, 9 price booms was that a lot of people have had the idea of investing into iron ore. So if you look at the iron ore, the announced capacity expansions, and we put a range depending on the category of the mines, based on whether or not there's existing infrastructure, it's close to another mine or not. So we have a whole set of parameters that we use to categorize all the announced expansions, and we apply some probabilities based on our best estimates, both on the delay versus initial announcement as well as on the realization rate of these projects. And we find a potential high case of about 1.3 billion tons of new iron ore capacity that we could see over the next 8 years, so by 2020 on the market. And in our lowest case, our most negative case, we would see about 820 million tons. And by the way, as a reference, this 820 million tons, that corresponds to only 1/3 of total announced potential capacity expansions, whereas our high case would be a bit more than 50%. So from this you see that actually the needed additional capacity of 810 million tons is towards the low end even of our what we believe to be already a conservative low case scenario of new capacity. So in short, we have some overcapacity in the iron ore market today, and going forward we expect the overcapacity to sustain, potentially even increase if people are not careful at the speed at which new projects are brought online. The one other factor which I already touched on in the global minerals presentation, in the first section of this presentation, is cost inflation. So as we saw there, cost inflation used to be 18% per annum in nominal terms for iron ore, or 15% in real terms. Going forward, and this is our best estimate using a number of drivers, we might be off on a few of them, but I think in general the global average leads to a 5 to 6% per annum cost inflation. And according to some of my colleagues, this is even a very conservative estimate. They would rather go for 6, 7, even 8% on average cost inflation per annum for the marginal producers. And an important part of that is geological inflation. As I explained, we go to more and more lower grade mines requiring more materials to be mined for the same output, require more expensive beneficiation cost and energy cost, etc. On top of the normal real inflation you will have on labor rates and some of the other factor costs. So what we then did is we looked at the need for new capacity. So about 810 million tons of new capacity would be required by 2020. What price do people need to believe into, long-term price forecast do people need to believe into in order to be incentivized to just bring online this 800 million tons using our cost and investment estimates that we have for each of these mines, with applying some of these inflation figures. And what you then see is that if you believe the 5 to 6 of annual real cost and capex inflation for the mining industry, for the iron ore industry on average, you would need a incentive price, if you want a long-term incentive price, CIF China, and this is for a 62% Fe equivalent product, sinterfeed, around $115 to $140 per ton. So this should be the incentive price that you assume that you need in order to be able to bring online what needs to be brought online to satisfy demand. So yes, this is significantly lower than the prices we have seen in 2008 and 2007. Still, I would argue it's not much lower than current prices are, and it's substantially higher than the dip that we have seen in September of last year. So we are still relatively positive, one can call it bullish depending on where you come from, on iron ore prices going forward, exactly because of this cost inflation reason. So this is how we believe cost curves will evolve. And so you have, of course, offsetting effects. And on the left-hand side, you see the global cost curves. On the right-hand side, the seaborne cost curve. So there's a couple of offsetting effects. One is, of course, marginal producers, currently high-cost producers, especially in China, where marginal production sits somewhere around $140, $150 per ton. That we believe, with the cost inflation that we see in China, where it also has been 15% on average over the past 10 years, those capacities will either deplete or disappear. So you have a new tail of marginal producers coming into play into the global cost curves, and both factors, so the overall cost inflation versus some disappearance and depletion of marginal producers are, at least on a global cost curve, offsetting each other. So you see that the shape of the cost curve doesn't change that much. On the seaborne curve, we still see quite a steep tail of the cost curve, but I am not convinced that these really will influence prices, as there is quite some overcapacity in the seaborne market, and actually you don't, in our view, we won't be needing this high cost tail of seaborne supply to satisfy the seaborne demand. So this brings me to my last page then, as to how the seaborne cost curve could look like. And we have a way to look at prices which is based on historical analysis, where we see that prices are always set against the cost curve, and depending on where you are in the pricing regime, in the supply-demand dynamics, you can either have cash cost pricing, where you have more or less cash cost of your 19th percentile of the cost curve. So we don't take into account this tail, where of course there's a lot of uncertainty on the real cost, but we take the 19th percentile, and then if you believe you're in a brownfield regime or in a greenfield regime, you should see prices up to $140, $145 per ton from a cost curve point of view, which is in line with the incentive price that I spoke about earlier. So in short, a lot of volatility to be expected in iron ore prices, especially now that we're in a spot pricing regime with overcapacity in a steep cost curve, but a solid long-term price driven by exactly those steep cost curves and underlying cost inflation. I would like to stop here and ask for questions if there are any. There's a question over there in the front. Do we have a microphone?
Difficulties of the Chinese steel producers in absorbing iron ore at 130, 140, 150 affect the analysis you presented, which is mainly driven from the supply side?
Well, it's not only the Chinese, of course, who are suffering from that. Coming from Europe, I can tell you that Europeans are suffering even more. But it's a good point. There's clearly a margin squeeze on the European and on the global steel players. Now, if you look at it, when were the best years for the global steel industry, when were prices and EBITDA margins highest, is when we saw raw material prices highest. So there is no real correlation to be found, and if anything, it's the opposite, between cost of raw materials and the margins that steel makers make. So what really, if you look at margin over raw materials historically, you see that there's and I take it for instance on hot rolled coil level, there is a band, and you see that margins remain within that band over a 20-30 year period when corrected for inflation. And where you are in the band of the margin over your raw materials is not so much driven by raw material prices, but is driven by global supply-demand dynamics, by tightness, by capacity utilization. So iron ore prices, when they're high, they will push up steel prices, but it's really the steel market dynamics themselves which drive by how much they're pushed up and whether you're rather at the low end of these margins over raw materials versus the high end. And the one argument that used to be made is that vertical integration will mean that those players who are not vertically integrated, they will suffer and this logic will disappear. But although a lot has been said about vertical integrations, we don't see, if you look at the total amount of iron ore and coking coal, but take the example of iron ore, it has been stable on around 22, 23, 24% of global iron ore, which is owned by steelmakers, and we haven't seen that change a lot over the past years. So also that is quite stable. So it remains, most of the market is still based on non-integrated raw materials. There's a question there, the gentleman over there.
On your your marginal argument, what percentile or percentage of the producers are actually do earn a fair margin at this stage in the current situation, just roughly? And what would that average gross margin be? More or less, just an average again.
So the average gross margin, so if I can go back on my, no, I can't go back anymore. So as you've seen from the global cost curve, I would say that on the global cost curve with the prices of $18, where we had that dip, you were around 80% of supply. Meaning that even with the dip of September below $80, there's still 80% of the players which, at least on a cash cost basis, are in the money. And then knowing that the cheapest ones, your cheapest quartile, I would say average price maybe around, corrected for value in use, would be around $40–50 per ton. So you can calculate your margin, which is still substantial. And then again, this was only a temporary drop. We're currently back at 150, 160, which is basically more or less the marginal cash cost of the global producer. So everybody who can sell is more or less in the money with today's prices. If there are no more questions, then I thank you once more. One more? Okay, there's apparently one more question. Okay.
Yeah, just a quick question. You mentioned the Chinese steel mills were using non-beneficiated iron ore with the depressed steel prices during the summer of 12. Mm-hmm. When we look at the iron ore demand or the iron ore supply in China, do you think that'll be an ongoing trend where every steel price weaknesses they'll return to that type of policy?
No, I don't think it's a trend. I think it's a very temporary measure that the Chinese steel industry has done with a slowdown of steel demand and pressure to keep blast furnaces going. I don't see this as a trend. I don't think it's sustainable. You cannot sustainably run a blast furnace or part of your on partly unbeneficiated ore. That will, in the long term, will kill you from a cost point of view. So you need to go to high quality raw materials, to good quality sinter and pellets, to get the lower coke rates, higher PCI rates, because we haven't mentioned coking coal, but if we're bullish on anything, it's about coking coal, again, from a price cost inflation point of view especially. So no, it's not something that I would see as a trend, but it's a temporary measure of steelmakers who are confronted with a very slow demand, who want to keep, but not expecting this very slow demand to take for a very long period, and therefore they don't want to mothball blast furnaces, so they lower the FE grade in sintering to slow down the blast furnaces. That is my current interpretation.